Semiconductor stocks continue to print. Stop relying on bonds for safety. I'm Ron DeLegge with ETF Guide. We're going to cover all of that and more. Let's get right to it. With your big picture view of the major asset classes and the ETFs tracking them since the start of 2026, this is a year-to-date performance chart through the market close of May 1st. The runaway leader continues to be commodities. SDCI ahead by just over 29% since the start of the year, boosted, of course, by higher energy prices. But there's a lot of other commodities inside SDCI besides oil and gasoline. You've got exposure to other key areas like the metals, which I'm going to show you in a second what's going on in that area. You've got SPY, which tracks the S&P 500, ahead by almost 6% since the start of the year. And really, the only areas that are flat or negative are the U.S. bond market, BND, and IBIT, which tracks the price of Bitcoin. So that's your big picture view. We mentioned SDCI, and I continue to harp on it because many of you still don't have diversified exposure to commodities. It's a missing area of your portfolio, and it will complement an all equity, all fixed income portfolio, all crypto portfolio because it does something completely different than those asset classes. SDCI is one of the best in the business, best in class, 5-star rated. Look it up. And it's from USCF Investments. We've got links, by the way, in the description section below. This is, by the way, what I would consider a core holding. You've got 3 cornerstones of an architecturally sound investment portfolio, your core, safety, and non-core. So SDCI, where would this go in the context of an overall portfolio that's architecturally sound? Like I said, that would go inside the core bucket, complementing diversified exposure to those other major asset classes, stocks, bonds, commodities. Commodities, of course, SDCI, but then real estate and also cryptos, right? A diversified crypto approach, not a single commodity crypto approach. Now, in terms of S&P 500, this is a chart that was highlighted by Meb Faber, talking about the yield on the S&P 500 just hitting an all-time low of 1.08%. That's an all-time low going all the way back to the 1800s when they were still wearing bow ties and drinking sarsaparilla. The prior low was 1.1% in the year 2000. I don't remember what happened that year. Does anybody remember? Hit the comment section below because I don't remember what happened in the year 2000. But there are now dividend mutual funds with negative yields. How could that possibly happen? Well, you take your yield minus what the expense ratio is, and that could create a negative yield situation, right? Especially if your expense ratio is 1.5%. Well, really anything above 1.08% is going to put you in this ungodly territory, right? Of a negative yielding mutual fund, not a good situation if you're into dividends. So again, I think this makes an argument, obviously, for the low-cost benefits of ETFs because they contain expenses, meaning you're able to extract more yield, more return at the opposite end for you, the shareholder, the investor, and that's a good thing. But the other thing, too, is this really points to a market that's very concerning. When you see dividend yields this low, we got to really reference history and be concerned about the trajectory of markets and also the safety of our own investments in this type of climate. In terms of S&P 500 industry sectors, we got 7 up, 4 down. The runaway leaders continue to be the energy sector, XLE, blowing away everything else. Some of those leveraged ETFs, I didn't chart them in today's episode, but ERX, put that one on your radar. GUSH, GUSH, put that one on your radar. These are some of the ETFs that are doing really, really well in the energy space that provide leverage exposure. Time to be using leverage is when it's trending sharply in the same direction that you're trading. That's when you want to use leverage. That certainly describes the energy sector right now. Some of the lagging areas, you've got healthcare, financials, consumer discretionary, and the communication services area. All these areas, by the way, are down modestly, not what we would consider bear market territory. And as far as industry sector ETFs, where would those fit in the context of an overall portfolio? Well, that would be the non-core, because they're more concentrated in their approach. They're less diversified. They're more risky. Obviously, you also have a chance for perhaps higher upside than a broader market index fund or index ETF. But this is where they go if you're going to use them inside a well-built, architecturally sound investment portfolio. Everything has a place, right? So this is what we're trying to do. Compartmentalize or organize your portfolio. Now, this is another non-core type of asset. Take a look at semiconductors. Soxel, which has skyrocketed 210% since the start of the year, and it's really made a move here over the last couple of weeks. TSXU, which aims for double performance to the top 5 semiconductor stocks, ahead by just over 42, almost 43%. And then Lint, LINT, which offers 2x exposure bullish to Intel. That ETF just skyrocketed. It's up 453% since the start of the year. And again, like the rest of the semiconductors, has really made a move here over the past couple of weeks. Avgo is another one, tracking Broadcom with leverage, 2x. Check out that one. So these are a couple of ETFs in the semiconductor space that are working. These are trades on the bullish side. And again, hit the description section below. We've got links for you on these. Also, this is a deeper dive into the Titans leverage ETFs, which take that top five stocks in each of these major sectors and uses 2x daily exposure or leverage on these ETFs. So again, the Titans leverage ETFs, another alternative or way to trade these sectors on the bullish side. And certainly check out some of these ticker symbols. In terms of metals, these are a couple ETFs I wanted to bring to your attention, along with uranium, which has been making a move very quietly. URNM ahead by over 22%. That's the Sprott Uranium ETF. I didn't chart the juniors. The juniors are also doing good. URNJ. So check them out. SETM, which is a broadly diversified critical materials ETF, doing very well, ahead by over 27%. And then copper and silver also holding some pretty nice gains, but you've seen them pull back here in 2026, and certainly an opportunity, I think, to add more to these positions, because these particular ETFs, we've talked about them many times, I think have a pretty strong and long runway ahead. Now, in terms of something else you need to be aware of, in case you didn't get the memo, runaway government spending, runaway debt continues here in the U.S. Wall Street Journal posting an article about U.S. debt now exceeding the size of the economy, a once unthinkable threshold. Well, it's not unthinkable because of the runaway reckless spending that continues in Washington, D.C., and absolutely no concern whatsoever about runaway spending, no political will to do anything about it. You could see we're at wartime levels. We've gone back to the future of the 1940s. We're now, as a share of debt held per GDP, 100%, over 100% debt to GDP, and it's pretty alarming. And it also is right now creating an unstable situation in the bond market. Let's go to Jamie Dimon and see what he had to say about that.
When things which we know are volatile, when they move up and down, it's not so worrisome. But if something we think should be stable is moving a lot, it's pretty scary. So given the level of government debt around the world and in your country, how worried are you about that?
You know, I'm not that worried we'll be able to deal with it. I just think maturity should say you should deal with it as opposed to let it happen. The way it's going now, there will be some kind of bond crisis, and then we'll have to deal with it. And it will be okay. It's just not the way to do it. But you mentioned to us, the level of things that are adding to on the risk column are high, like geopolitics, oil, government deficits, and they may go away, but they may not. And we don't know what confluence of events causes the problem. So if you look at all economic history, it's different confluence of events. different tectonic plates in each other. And they may affect 2026, they may not. But they need to be resolved. And if they're not resolved properly, they will cause real additional problems down the road.
So as you could see there, Diamond sees big problems in the bond market. I concur. And, you know, the hyper-nationalistic posture of the U.S. is creating anti-American sentiment for U.S. assets. That's the dollar as well as U.S. debt. And the things happening on a political level are really accelerating some of the things that are yet to come in terms of financial instability. And so from an investor's perspective, those of you still holding bonds, pretending that or thinking that they're going to give you some sort of safety, I take you back to 2022 to remind you that bonds were not safe during that particular pullback. And we see that bonds sunk right alongside stocks. BND, TLT, which track a mix of U.S. government bonds as well as corporate government bonds, investment grade, that's top-rated bonds, they sunk right alongside stocks. And so you see that in times of instability, you don't necessarily get safety from bonds. And especially if we're heading into a crisis situation where there is a selling of bonds as well as a potential default on government debt, all of that would signal big trouble ahead. And so when we talk about the safety bucket, right, this is one of the cornerstones of a well-built portfolio. We never use bonds because bonds do not offer 100% principal protection. They do not necessarily diffuse market volatility, as 60/40 portfolios learned the hard way in 2022, and they'll learn the hard way again in the future. And again, if you're going to use bonds, you can use them in your core portfolio, you can use them in your non-core portfolio, but you can't use them and should not use them in the safety bucket. They have no place in the safety bucket whatsoever because they do not protect your principal. There is always a chance for default. And, the textbooks taught us that, government debt is risk-free. Well, the textbooks are wrong. U.S. government debt, any government debt, is not risk-free. There can be and have been many examples of defaults in the past, and so that's just a nasty reminder that it can happen again. And what do they say? History repeats itself. So from the investor's perspective, it's important that you use the right types of assets to protect your portfolio. We talk about them extensively in our online course, Safety. You can hit the description section below. I get into that extensively. And I'm also going to be doing an upcoming webinar all about this because I think it's just such an important topic that you need to be prepared for. In terms of our Billionaires Index, I remind you where the big money is. This is a real-time look. And you can see the top 8 out of 10 billionaires. Where did they make their wealth? Where's their wealth concentrated? Well, it's in the technology sector. And that won't change. That won't change. And from an investor's perspective, that's, in my estimation, my opinion, how you should be allocating and emphasizing your own investment portfolio. Tilting it towards technology, that's where the action's at. And it will be for the foreseeable future as the digitalization of life and the economy and the business continues. In terms of new upcoming episodes, we've got a ETF Battles episode that will be dropping this week. We've also got new episodes coming for Metals in Motion as well as First Look ETF, so be sure to check them out right here on our channel. If you're a new viewer, be sure to subscribe and hit that like button. Let us know how you're enjoying our content. And that does it for today's episode. Hit me in the description section below with your comments. What do you think about runaway national debt? What do you think about what Jamie Dimon said about the bond market on course for a potential crisis? Well, a lot to consider. I'll see you on the next episode. I'm Ron DeLegge with ETF Guide. Take care.